I'm still blown away how many people believe in this lie. Just buy into the stock market, let's say an S&P 500 ETF, hold it long term, forget about anything else, because long term things are going up. That's the lie. The reason why it's a lie, and the reason why that lie is so persistent, is because it seems on the face of it very logical. Yes, the S&P 500 is going up, but do you know what's also going up? It's the number of US dollars floating around over time. The US money supply grows by 6.8% per annum, and that growth drives all asset prices. That's why property is going up. That's why the gold price is going up. That's why oil is going up. And that's also why the S&P 500 is going up. The argument for the S&P 500 or for investing in stocks is not an argument pro stocks. It's an argument counter fiat currency. So really, we just have to get out of the fiat ecosystem, and then we have to make our own decision. What is actually the best investment to get into? Should it be at a particular point in time the stock market, or should it rather be property, or should it rather be gold? Now, we never want to be 100% into anything, but we definitely want to have a higher weighting towards a cheaper thing and a lower weighting towards the expensive thing. You don't follow the lie that you can just buy into the S&P 500 and you will be good long term. That's not true. You will be better compared to holding fiat, but holding fiat long term is stupid anyways. Let's say, for example, we had to make the decision. Should we now buy into the S&P 500 or should we now buy into gold? This chart here gives a good answer. This is the S&P 500 divided by the gold price. Now, why does this not look as fancy as this chart over here? It's because both prices are impacted by the monetary debasement. If the dollar suddenly doubles in its supply, then both the S&P 500 and the gold price will double. And so this chart is then a good reflection of the stock market's valuation relative to gold at particular points in time. This is when the stock market is expensive. This is when it's cheap, expensive again, cheap again, expensive again. And currently we are slightly above the long-term equilibrium, which is this dotted line. Fundamentally, we just want to escape the money printer. And if we want to make additional performance on top of that, we have to time the market. And with timing the market, I don't mean buying and selling the S&P 500, getting into fiat, getting out of it. I'm talking about having the right weight of different portfolio allocation. Should we be more in gold? Should we be more in stocks? Should we be more in the property market? So just based on this chart, we can already say that the S&P 500 does not outperform the gold price that much long term. From this peak over here at the end of the 1920s, subsequently we had the Great Depression, to the top of the internet bubble, we saw growth of the S&P 500 of 267%. That's over the course of 70 years. Let's run the numbers and look at the annualized outperformance. It's 1.9%. That's how much better the stock market was relative to gold. And this is now excluding potential fees that you might have with the stock market. Let's say management fees on your actively managed fund. Let's say taxes if you decide to buy and sell a bit quicker. 1.9% of additional performance over the course of 70 years really isn't that much. It can easily be eroded away if the portfolio isn't set up properly. And that's again implying that this is the long-term growth rate. And that should rather be the performance over the decades, which we don't know, right? Maybe this is just a long-term sideways trend, as in the bottoms, they align pretty well over a long stretch. So from here to here, that's 100 years. Now, there have been some asset classes that actually were able to beat monetary debasement. This year, that's the Nasdaq 100. So technology stocks divided by the gold price. Here we do have some growth rate. Let's just connect those two bottoms over the course of 23 years, an outperformance of 355%. That's an additional return of 6.8% per annum. So that's tech stocks versus gold. And so this is how I think about this fundamentally. Within an asset class, we tend to have a lot of correlation, as in when the stock market goes up, then all of the stocks go up at the same time, or when the stock market goes down, all of them go down. There's very little individual movements. That's true for the stock market, but it's also true, say, for the property market. When the property market is going down, then all the houses are going down. It's also true for crypto, right? When Bitcoin crashes, most altcoins crash with it. So within an asset class, we've got a lot of correlation. We cannot really diversify our risk by owning different things within an asset class. Instead, we diversify our risk by owning different asset classes. So we want to have the best in each asset class. So for crypto, for example, it's good to have a very strong allocation towards Bitcoin and not towards the smaller altcoins. And I follow the same approach for the stock market. When we invest in the stock market, we don't necessarily want to own stock number 400 in the S&P 500. Instead, we want to own the winners. We want to own the Bitcoin of the stock market. And what we see over here, that's the Nasdaq 100, so technology stocks, relative to the entire stock market, the S&P 500. Tech long-term outperforms traditional stocks. Growth stocks are called growth stocks for a reason. They outgrow long-term. Now this year, that was the dot-com bubble. And we could make the argument that tech stocks are now even more expensive compared to the height of the dot-com bubble. But I think we are just growing at a predictable rate. We are not increasing in valuation at the same pace we used to at the end of the 1990s. where tech stocks outperformed regular stocks by close to 200%. And then subsequently, they underperformed by more than 66%. That's not the situation right now. We are just in line with our long-term growth trend. Now, the Nasdaq 100, on average, measured in fiat currency, returns roughly 14% per annum. That's much better than the S&P 500. But there's even a way to squeeze out a little bit of extra return without even having to make a bet directly on technology. And that comes from this backtest over here. This looks at different S&P indices. We've got the S&P 500, that's the line in orange, and we've got the S&P 1, that's the line in blue. So there's always, at a particular point in time, just invests in the largest equity in the US stock market. This used to be General Electric for a very long time, then it became ExxonMobil, then it became Apple, and right now it is Nvidia. So we don't diversify across 500 stocks the same way we would not diversify across 500 different altcoins. We are just buying the number one. And right now that is Nvidia. And if we followed that approach long term, we would have had generated 17.5% per annum versus just 10.5% for the S&P 500. This is a 7 percentage point difference every single year. And over the course of this backtest, which by the way starts in 1990, that makes an almost 10x difference in final result. This here is on a logarithmic scale. Once we look at this on a linear scale, the differences are very impressive. And again, we don't even have to make the call that we always buy technology stocks. We just buy the thing that's currently the most valuable company on the US stock market. And in this backtest, we're not even rebalancing our portfolio all the time. We just look at the largest stock at the beginning of the year. And then we hold it for an entire year. And then the next year, we look at the largest stock again. So this can also be optimized in terms of taxes, right? We don't trade in and out of the asset all the time. So I like this approach much more compared to buying the S&P 500. Getting into technology stocks over the regular stock market is already better, but getting into the largest stock in particular, that has even a slightly higher edge. And it's a bit less of an opinionated bet. So right now, Nvidia is that largest stock. Here's the Nvidia price relative to the S&P 500. This chart starts in 1999. And this here is Nvidia relative to the Nasdaq 100. So how did Nvidia do relative to all other technology stocks? And actually, I'd make the argument that Nvidia isn't really that expensive given that it's at number one and given that it's at the center of the entire AI movement. In the last 2 years, Nvidia stock has not outperformed other technology stocks. It just went flat. And that's surprising given that Nvidia has such a moat around its business. Everybody wants to get Nvidia chips and no other company is getting close to their performance. But is maybe another company getting close to flipping Nvidia soon? Should we still buy it? Or will there be a new number one in the next months? Here's an overview of the S&P 500 stocks. Nvidia has a weight of 7.4%. Apple is number 2 with 6.4%. So maybe Apple could flip Nvidia. Now here is Nvidia relative to Apple. It actually tended to outperform even over the last 2 years. So the gap between Nvidia and Apple is widening. I do not see Apple outperforming Nvidia anytime soon. But again, we try to not be too opinionated. If that flip was to happen, and it's again the 1st of January, then it makes sense to rather bet on Apple over Nvidia. It's actually interesting when we look at the volatility of those relative valuations. At the beginning of the 2000s, so when the dot-com bubble burst, Nvidia underperformed Apple stock by 99%. Those shifts in momentum do matter. And if you're buying an index, you're not taking advantage of any of those shifts. Is there more risk in buying a single stock over 500 stocks? Yes, of course, but I think that risk is very much justified. This here is again the top stock versus the S&P 500. What's the alpha year over year? Most years we tend to have more return. Not every single year, but definitely for the vast majority of years. And yes, our volatility goes up. It's 27% per annum versus only 17% per annum. But I think those 10%, less than that even, in additional annualized volatility is definitely worth it, given that we expect 7 additional percentage points every year in return. The risk versus return is much, much better. In other words, the Sharpe ratio is higher for the S&P 1 versus the S&P 500. The investment game is all about opportunity cost. It's all about should we buy A or B. It's not about should we be in fiat currency or A. It's always about what as a class is currently the cheapest. Because think about it this way. Let's say you were to win the lottery and let's say you suddenly have 100 million US dollars. You would not choose to have that money in any fiat at all. You just try to figure out where should I invest those 100 million? Very little, if any, of that capital would be just in fiat currency, in paper money, because you know that paper money goes down over time. But interestingly enough, when people don't have 100 million, when they've got less money, they tend to rather think, oh, this is too volatile for me. I rather have my money safe in cash. But cash isn't really safe. Cash is a safe loss generator. All we can do is reduce our volatility and reduce our price risk with our investment. And hopefully buy the thing that will do better than the rest. But being in cash is no alternative. And completely forgetting about valuations and just always buy into the S&P 500 is also not a good idea. Again, because measured versus the monetary debasement, it can take a very long time until we get our money back. Putting in the effort to buy the long-term outperformer does pay off. Those returns compound, right? 7 percentage points per annum additionally made a 10x difference over 35 years. If your retirement account at the end will be $1 million or $10 million, it does make a difference. But yeah, the reason why most people never achieve this is because they are too lazy to learn it. But feel free to check out the premium videos on this channel. This is where I get into much more detail around investment management, what kind of things to buy, and where we can potentially outperform without getting into too much additional risk. For example, recently, interest rate arbitrage is very attractive. I make more than 20% per annum on that. It's a bit more complex, it requires some learning, but again, that learning pays off. It does pay off to compound capital faster than others. If it's your first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. Helps the channel grow. See you next time here on YouTube or see you on Premium. Link to that pops up here on the screen. There's also a 7-day money back guarantee. In case you don't like Premium, you can watch all of the videos. You can still decide, I don't like it, then just message me within the first 7 days and I'll refund you. No questions asked. See you next time. Cheers.